Ed, we've lived with a lot. We've lived through a lot, certainly since the pandemic. This market's got through a lot. I recall a conversation I had with Bill Dudley, the former New York Fed president, where early on coming out of the pandemic, he was talking about Fed funds that might need to get to 5%. And at the time, it sounded absolutely crazy, because if you said to anyone in this market, the Fed would take rates to 5%, they would expect the economy, both the economy and the market, to crater. And Ed, that didn't really happen. Do you think we can live with this?
No, well, you might recall back in the early part of this decade, I was one of the few who said that we're experiencing the most widely anticipated recession of all times that isn't going to happen. It all speaks to the resilience of the economy, the consumer, capital spending. Look, my view is, I know I'm supposed to get all panicked here because I coined the phrase bond vigilantes, and so I should get everybody all stirred up that they don't like what's going on. But I think 4 to 5% is kind of back to normal. I really dislike that phrase that interest rates are going to stay higher for longer, because it implies that somehow or other we should be getting to lower interest rates. I think we're back to normal interest rates. 4 to 5% is normal. I think it's a healthy sign of a healthy economy. It's a sign that the capital markets are properly allocating capital and the economy can deal with it just fine.
Ed, leverage and debt, is the backdrop for that built up over the last decade plus different to what things looked like pre-GFC? Because I hear that a lot. Pre-GFC, we're going back to normal. This is what it used to be like before we had the era of repression. Ed, do you see the backdrop as different, though? So, yes, we're going back to normal for yields, but is the backdrop different for leverage, for the debt levels? Does that make it more complicated?
Well, the debt levels are certainly higher, but everything is relative to the size of the economy. The debt levels are elevated, but they're not. You don't want to compare them in absolute terms. And everybody keeps talking about the $40 trillion of government debt. If you take out the intra-government investments in its own debt, sort of the government buying its own IOUs and Social Security Trust and other areas, we're talking about $31 trillion that's held by the public. Now, I know that's a lot of dough as well, but everything is relative. And until recently, nobody was particularly concerned about things. The auctions were going perfectly fine. In 2023, it was the auctions that got everybody spooked. But at 5%, a lot of people said this is a great yield. And we may get to 5% this time around, and I think you'll see the same reaction, that this is a great yield to lock in.